Hello and welcome back to The Note. The average active equity mutual fund manager fails to beat the index. I think everybody probably knows that by now. But the question is, which index? What is the fairest index to compare a stock picker against, and what does that tell us about how we should be managing equities? With me now is a man who has been thinking about these very important topics for a long time. He's the head of strategy for S&P Dow Jones Indices, Tim Edwards. Tim, thanks very much for joining me today. Let's start by taking a look at a classic comparison. This is the relative performance of US large cap funds against the S&P 500. Not very healthy.
No, I mean, on average, as you said in your introduction, the average active equity mutual fund fails to beat its index. And in this case, the index we're talking about is the S&P 500. Now, you do see 2009, actually, active managers did rather well. And that's something maybe we'll talk about a bit later. But on a year-to-year basis, you're seeing, give or take 1 to 2% underperformance of the index, which does suggest that maybe it's better to index and just take a low cost. Okay,
and let's take a look at the number of funds involved. And you can see again that this translates into your chances of any one fund beating the index, the great majority of them. Even, in fact, in 2009, barely any of them actually managed to beat the index.
Yeah, that's something you say. And if you go over a longer time period, this is for 1 year. So, on average, let's say 55% of funds fail to beat their benchmark. If you take it over longer time periods, that proportion will increase and fewer outperform. The point you note that even in 2009, which was a good year for active management, it still looks like most actually underperformed their benchmark, but the ones who did outperform in such a volatile year did so by so much that you see that coming through into the average as a positive.
Okay, but it does sound, to quote Taleb, as though we might all have been fooled a little bit by randomness when they did that well. Now let's take a look. You have been talking about the concept of the equal weighted index as being perhaps a better benchmark. You can see that S&P equal weight is a much harder benchmark to match than the market cap weighted index. Can you quickly explain what the equal weight index is and why you would make that argument for it?
Sure, and I'm glad you brought up fooled by randomness, because an equal weight index is really crucially connected to the concept of a random stock selection.
Right.
The S&P 500 is market cap weighted, which means bigger companies get a bigger share in the index. The equal weight index is just equally weighted all 500 stocks. The important consequence of that is it actually gives you the performance of the average stock. If you want to know what the performance of the average stock is, take all the stocks, add their returns, divide by the number of stocks. Right. That's how we calculate that index. Now, the significance of that is you think to yourself, what is the performance of an average stock picker? Let's say I just pick one stock and I go 100% in that stock. What do I expect to get?
You don't expect to get the market. You get
exactly. You don't expect to get the market. You expect to get the performance of the average stock. Now, when you move to the concept of an active manager and the way that an active portfolio is often constructed, you'll have some way of picking them, 50 stocks, say. The natural way to combine those is equally. So for those two reasons, that it's the performance of the average stock and that it's more like an active portfolio, we think that the equal weight index can be a very complementary benchmark in terms of judging.
Well, complementary in one sense of the word, deeply uncomplimentary to active managers, and this makes their performance look really,
it's done a lot better.
Really terrible. Yeah. Now, very quickly, that tends to suggest that there's even more of an argument for smart beta strategies where you weight by something other than market cap. Is that fair, and are all smart beta strategies created equal?
Good. It's a great question, and I think this chart, a great way to make a point is you might say, well, look, equal weight outperformed. You could flip that on its head and actually say weighting by market cap underperformed. And in fact, if you sort of take equal weight as the benchmark, what this outperformance of equal weight strategies has done is symptomatic of a wider range of truths, which is all these so-called smart beta. I mean, are they really that smart? But alternative weighting mechanisms, many of them have outperformed. Part of the reason for that outperformance is simply that they don't weight by market cap. And so an equal weight benchmark can tell you more precisely if it's actually adding value or not.
Okay, Tim, thank you very much indeed. I hate to say this because I'm supposed to try to find nice positive things to say about active managers, but it does make all this research puts the traditional active manager in an ever worse light. What's intriguing is that they have been losing ground to cap-weighted index managers over the last few years. Perhaps we should be moving on from them as well.